Cash flow statement, that will be chapter 17 for us. We're getting close to the end. This one and one more chapter and we're done. Tell me what we're going to do here. Why usually company buying own shares? If the company buy his own shares, what's going to happen? Obviously, we're not going to save cash because we're the one who paying the cash. That will be out of the window. What do you think the effect will be if the company pays back its own shares? Obviously, it will be impossible to increase the number of the shares since we're buying our own shares. That's basically decreasing the number of shares. But if we decrease the number of the shares, what's going to happen? So we're chasing now, obviously, we're chasing between A and B. What would you expect? To decrease the price per share or increase the price per share? Increase the price per share, okay? And the next one, which one you think is not going to be recorded? Oh, sorry, reported on the statement of changes of the shareholders' equity. Not recorded, reported. Let's think about it. If I buy my own shares, do I have to report it on the statement of the changes of the equity? Yes. If I declare stock dividend, do I have to report it on the statement of the changes of owners, shareholders' equity? Why not? I have to show the increased number of the shares. I'm declaring stock dividend. There definitely will be reporting on the statement of the, I don't have to record it as a transaction, but I have to report it and show the increase in the number of shares. How about if I issue preferred shares? Do I have to report it? Yes. How about if the market value of the common shares changes? Do I have to report it? No. Make sense? So now let's go with the cash flow statement. What we're gonna do cash flow statement? Cash flow statement is the fourth required statement as a part of the financial statements. So we have financial statement start with the income statement. Statement of the changes in the owner's equity is the second one. Next one is the statement of the balance sheet. And the fourth one is the cash flow statement. It reports simply from where the cash coming and where the cash going. So basically, we're chasing only and only cash. We have two methods to report, two ways to report the cash flow statement. One is direct approach, the other one is the indirect approach. Both methods are allowed to be used by the companies. CPA Canada Handbook prefers the direct approach. However, most of the company using the indirect method. For that reason, here in this course, I'm gonna focus on the indirect method. I'm gonna show you how the indirect method works. The cash flow statement. The cash flow statement reports the entity cash flow, the cash that's coming from the receipts, and the cash payment that the company made during the period. Cash flow statement is for the period of time from January 1st to December 31st. If we don't have a time, there will be no cash flow statement. It's going to summarize all the transactions that affect only and only cash and cash account. Again, for the period of time. So basically what we're going to do, we're going to get the cash account and we're going to start chasing what came in on the debit side and what went out on the credit side. Debit side always going to be increase in the cash. Credit side always going to be decrease in the cash. What can increase our cash? First, collection from the customers, interest received on the notes, issuance of the shares, issuance of the bonds. If we receive dividend, that's going to increase the cash. Where are we going to spend the cash? When we pay the suppliers, when we pay the employee, when we pay income taxes, when we pay for the assets, when we pay for the loan. If we give the loan to another company, when we make investment, we have to pay cash. If we pay dividend, we have to pay cash. If you repay the loan, we have to pay cash. If you repay the long-term loan or the bonds, we have to pay cash. Those all the events gonna decrease our cash. And at the end, we're gonna see which one is higher. The amount that the money, the cash that's coming in or the cash that's going out. If the increase is higher than decrease, we're gonna end up with debit ending balance. That's preferable situation. So, how on the timing of the financial statements? Again, we're going to have the balance sheet at the beginning of the year or at the end of the year. Then the new year starts. When the new year starts, the period starts. For that period, we're going to have three statements. First statement will be income statement to show how much the company earned. Second statement will be statement of retained earnings to show how much of the earnings move to the retained earnings or move to the equity section. The next statement for the period of time, it will be cash flow statement to show us what's happened with the cash. And then we're going to have the balance sheet. And on the balance sheet, we're going to see what's the beginning balance of the cash, what's the ending balance of the cash. So the cash flow statement is going to explain how the cash went from the beginning balance to the ending balance. For the purpose of the cash flow statement is to helps to predict the future cash flow. So once you start reading the cash flow statement, you might be able to predict the future cash flow. Or you can evaluate the management decisions, what the management actually doing in this company, and how long this company can actually sustain. You can determine the company ability to pay dividends and debt from the cash flow statement. And you're going to see the relationship with the net income and cash. The one thing that you always have to remember, income doesn't mean cash. Net income is not equal to the cash. Now, the purpose of the cash flow statement. Now, the negative cash flow from operations obviously is going to scare the investors. Cash flow from the operations relates to cash generated by the use of the core business activity. We're going to see which are the activities and how exactly that affect the cash flow statement. But remember, the company open to operate. To the normal operation, the company generates income. From that income, company generate cash. If the company cannot generate cash from the operations, that's a problem. Negative cash flow for 2 consecutive years most likely means bankruptcy for the company. The other thing is if the company cannot generate cash from the operations, it will be very hard, pretty much impossible for the business to survive. Unless you have ginormous amount of savings which you're willing to put in the company. Over the long run, if the company cannot generate cash from the operation, basically it's going to be closed. So the most important cash flow is the cash flow from the operations. Now we're going to talk about what is cash. Well, as we see at 11:10, if you still remember that, in 11:10 we said cash is the cash on hand, cash in the bank, plus the cash equivalent. Cash equivalent is the highly liquid short-term investment, which can be money market funds or the government of Canada Treasury bills. So from now on, when I say cash, that means cash and cash equivalent. So all those are included in cash. Furthermore, if you have overdraft, that's also considered cash. Let's see identify the cash flow from operations of different activities in the company. In the cash flow statement, we're gonna start preparing 3 sections. Definitely, there are 4 sections, but 3 of them, the first 3 sections, the first 3 basic category of the business activities. First one is the operating activities. As you can see, everything is ink form. That means that's gonna continue. This is not like a end of the business. Operating activities, investing activities, financing activities. And for the cash flow statement, we're going to have section for each of those categories. Now let's see what will be the operating activities. Before I go to this, or actually I can explain and then we can show you. Operating activities. Operating activities including everything, all the cash that company needs to day-to-day operations during the operating cycle of 1 year, whichever is longer. That's where the company generate revenue. That's the period when the company having expenses, generate gains, or experience losses. Effect of the net income of the income statement is also part of the operating activities. Affect current assets and current liability on the balance sheet. So the operating activities simply shows you revenue, expenses, gain and losses, plus the changes of the current assets and current liabilities. Investing activities. In investing activities, we're gonna focus only and only on the long-term assets. We're going to chase the increase and decrease in long-term assets, which can include purchase or sell of the long-term assets. We may have include long-term loan that we giving to the other people, long-term investments, or collection of the loan, or the collection getting back the investments. This is the next most important cash flow after the operating activities. Obviously, operating activity is the most important category of the cash because again, it reflects day-to-day operation. If the company cannot generate cash from the operating activities, that means there's something wrong with that company. Operation doesn't work. Which operation is the main activity for the business. Investing is kind of peripheral kind of activity. And the last one is the financing activity. Financing activity, that will be the one that decreasing the long-term liabilities on owner's equity. That's going to include issuing of shares, paying the dividend, repurchasing company owned shares, or borrowing money and paying the loans. This is the least important if we have to show everything as by importance. The most important is operating, second important investing, the third important is financing activity. I won't say this is the least important, but that's the third on the list between the operating, investing, and financing activities. So that being said, the simple way you to understand from which one comes and how to use any of those, I'm going to go back to the Excel spreadsheet. I'm going to start with the basic accounting equation so you can see it and how exactly that one is going to be, how affect our cash flow and from where we're going to get information about our cash flow. So from the basic accounting equation, I share my screen with you. From the basic accounting equation, which is asset, which is equal to liability plus equity. And we already know that the assets, on the assets, we have current assets and we have long-term assets or non-current assets. On the liability, we have the same idea. Current liability and we have long-term liability. Now on the equity sections, we have two elements here. We have contributed capital and we have retained earnings. And that's about it. That's our accounting equation and implication of the accounting equation for our purposes. Then we're going to have the income statement, which income statement has simply sales minus expenses. Very briefly, sales minus expenses. We're not chasing anything else here. And we have net income, which net income eventually flows to the retained earnings. Make sense? Net income goes to the retained earnings. That's your link between the income statement and the balance sheet. So when we're talking about operating activities, from where the operating activity is going to come? Actually, I want this one to move up a little bit. Operating activity is going to come from this line. That's our operating activities. Investing activity is going to affect only and only long-term assets. And the financing activity is going to deal only and only with the long-term liability, contributed capital, or retained earnings. That's how you should remember it. First one is the operating. Second one is, here will be investing. And the last one will be financing. Those are the activity that we have, and that's from where they come from. Again, operating activity involves current assets, current liability, income from the income statement. Investing activity dealing only and only with the long-term assets. Financing activity dealing only with the long-term liability, contributed capital, and retained earning, or equity section. Now let's go back to the slides and keep going with the slides a little bit more. So the slides, again, are going to explain the same thing. Operating cash flow comes from the current assets, current liability, and income. Investing cash flow comes from the long-term assets. Financing cash flow comes from the long-term liability and owner's equity. Each of those categories is going to include cash coming in, cash going out, cash coming in, cash going out. Another way you get to see it. So from where you're going to cash on the operating activity, since we're dealing with the current assets and current liability plus the income, we're going to have collection from the customers, our sales, then we're going to collect the cash. Receive from the interest of the dividend on the investment. Either going to get interest, either going to get dividend on the investment. That's cash coming in. And other operating receipts, if there are any. From what we're going to pay that cash? For the suppliers, which is current accounts payable. Payment for the employees, current accounts payable. Payment of the interest in income taxes, current accounts payable. Other operating payments. Investing, from where the investing cash going to come? When we sell long-term assets, we get in cash. When we sell our investment, which are not cash equivalent, means money market or something highly liquid, that will be cash coming in. Or when we get our loan back. From where the cash gonna go? Gonna go for purchasing the long-term assets, or purchasing the investments, or lending the money to the other companies. Financing activity, from where the cash gonna come? When we issue shares. When we sell the shares that we already repurchase, or when we borrow money from the long-term debt. Where the cash gonna go? When we pay dividend, cash is out. When we repurchase our own shares, cash is out. When we pay the long-term debt, cash is out. Now, what we have to understand, operating activity, everything we're going to include discontinued operations in the appropriate sections. In the operating activity, we're going to include the interest that we're receiving, dividend that we're receiving, and interest that we're paying. Dividend payments will be reported in the financing activity section. Any cash component must be reflected in the cash flow statement. So every time when the cash is involved in transactions, we have to record it in the cash flow statement. Non-cash transactions are not part of the cash flow statement. Let's see one question here. Which of the following would not be correct in describing the cash flow statement? So most of those will be correct. We're chasing which one is not correct. See? Yes, that would be the correct one. Why? Because technically, generally speaking, we don't have investment activity in our cash flow statement. What kind of section we have? We have investing activities. Investment activity, not part of the cash flow statement. And interest received is usually part of the operating activity, not investment activity. Next one is the financing activity include. Which one the financing activity gonna include? C again, B. Let's think about it. Financing activity is related to the long-term debt or equity. Interest expense on loan. When we're paying interest expense on loan, that's part of the operating activity, so that's gone. When we get the proceeds from sales on land, is the land part of the liability or equity? Where is the land recorded? Asset. So that's automatically eliminated. Collecting principal payment on the loan made to another company. We collecting now the principal. Is that part of the equity or the liability section? Obviously not, because when we give the money, that's become now we become the creditor, or we become the investor in this case. So that's part of the current assets or long-term assets in this case. So the last one that left is the payment of dividend, and you're correct. B is the right one. Payment of dividend is the correct one. So how are we gonna measure the cash? Free cash flow is the amount of cash available from operations after paying the planned investment in the long-term assets. Now the free cash is computed as follows. Net cash, which is we're getting from the operating activities, minus the investments that we're doing in the capital assets, is going to give us the free cash flow. Now, when we're starting the preparing the cash statement of cash flow, there are two ways to format operating activities. So only for the operating activities, we have two ways to report the cash. One way is to use direct method. The other way is to use the indirect method. For the investing and financing activity, there's no direct and indirect. They're done the same way. Only operating activities having direct method and indirect method. Direct method is going to report all the cash receipts and cash payments from the operating activities by individual component. We're going to get the sales, we're going to get accounts receivables, we're going to get the cost of goods sold, we're going to get accounts payables, and keep going. Indirect method is going to reconcile the net income to the net cash provided by the operating activities. So in the first direct method, we're going to chase all the cash, including the cash that's coming from the income statement, where in the indirect method, we're going to start with the net income and then we're gonna chase the current assets and current liability. In both methods, we're gonna end up with the same amount. There should be no differences between in the calculation. I mean, there are differences in the calculation, but the bottom line in the both methods are the same. There's only one method for preparing the cash flow related to financing and investing activities. So financing and investing activities, there's no direct and indirect. How are we going to do the format of the cash flow statement? Direct method. It's easier to understand and provide better information for decision making. And learning to compute will help to understand the business activity impact the cash. So what we're going to do in direct method. In direct method, we're going to get the revenue, we're going to expenses, we're going to get net income, and then we're going to adjust for the cash from the cash receipts, accounts receivables, and adjustment for the cash payments, accounts payables. And we're going to come up with the cash flow from operating activities. Now, since the income statement, we're using a lot of adjustments, that will be here. We're going to have accrual basis accounting. Now, that doesn't help us for the cash, because for the cash, we want the cash accounting, which cash accounting, cash basis accounting, as you already know, is not permitted. We have to move to accrual basis accounting. So for that reason, we have to eliminate all the non-cash items, and we're dealing only with transactions which affect the cash. Any journal entry that doesn't have debit cash or credit cash are eliminated from the cash flow statement. We're only dealing with the journal entries that have either debit, either credit, cash. So, and then we're going to start preparing the cash flow statements by direct method. Direct method is not, we're not teaching in direct method. I can show you the direct method, but that will be after we finish the cash flow statement. After you feel comfortable with the cash flow statement using the indirect method, then I can show you the direct method. I don't want to confuse you in the very beginning since you have no idea about the cash flow statement. It's very important for me you to learn the things the proper way. And then once you learn it the proper way and once you understand it, then we can make some adding some more knowledge to you for your personal benefits. So first thing, we're going to compute the cash effect on the business transactions. In order to do that, you have to understand operating activities. First, we're going to start in the indirect method, we're going to start with the net income from the financial statements. Then we're going to make adjustments for the non-cash items, which are already in our income. Once we make those adjustments, the objective here is we to come up with the cash income. Once we come up with the cash income, then we start chasing the related balance sheet accounts to the revenue and expenses. How are we going to do this? We're going to see next time. I prefer to stop right here, and rather than at this point continue something more serious.